Shares of Levi Strauss are sinking today, off just about 17% after the company's 8% rise in sales. It wasn't enough to impress investors in the street. The Jeep maker stuck with its full-year outlook of sales growth of 1% to 3%, and now says it plans to cut back on costs by selling more directly to consumers, a strategy that we have seen from Levi Strauss. Let's talk about it with Harmit Singh. He's Levi Strauss CFO and Chief Growth Officer, joining us now alongside Yahoo Finance's executive editor, Brian Sozzi. Harmit, it's great to see you again. So let's talk about the quarter, because going into this, lots of questions just about the strength of the consumer, some of the trends that you are seeing. So talk to us about what you saw in the most recent quarter and whether or not that has continued up until today through this most recent quarter.
Good morning, folks. Thanks for having me. It's not the reaction we expected on the stock, but as you know, the stocks had a great run up over the last 12 months, on the belief by us and our investors that our longer term strategies to grow the company to a $10 billion company and deliver operating margins are, fairly strong. Overall, it was a strong quarter for us. We met our revenue expectation and significantly beat our EPS on the back of record gross margin. And as you said, we reaffirmed our full year guidance, which implies an acceleration in the second half, both for revenue as well as profitability. And that's after making investments higher investments in marketing, because the brand's having a moment, as well as transforming our distribution and logistics strategy. To your question about what's really driving our strategy, the first is our direct-to-consumer business, which is now close to half our business, was up 11% on the back of 14% growth a year ago. Second, our women's business is really doing well. It was up 22% in our direct-to-consumer business. And in the US, we are now number one, and that's not something that we could have said a couple of years ago. And so as we think about the US as a marketplace, this is the third consecutive quarter of the US growing. And so as you think about the business around the world, US ahead of expectation, Europe largely on our expectation, Asia slightly down, driven really by foreign currencies impacting their business. And our China business was a little soft, but ex-China, Asia was up 9% in constant currency.
Harmit, it seems like the street is locking in on the wholesale business, and I understand it did improve sequentially, but it was another quarter of it being down. Should investors just expect that business to be in a long-term structural decline?
You're right. Sequentially, globally wholesale, improved, but it was down. Our view, Brian, is that over the long term, the business will get to modest growth. But what's more important is that wholesale customers that are seeing our new product assortments, the wider loser fit, as we expand our addressable market and get into skirts and dresses for her, or the performance tech pant for him, are beginning to open their checkbooks and buy into the new product line, and that is working. And so I think thinking about this business longer term, our expectation is the wholesale business gets modest growth, but more profitable. The growth, our mid-single digit growth as a company, that's really driven by our direct-to-consumer business. It's a business that we can directly control. And so that will be the lead. Wholesale is a big, is a big business for us. It's an important business for us, and actually will complement direct-to-consumer. So we talk about the company making a pivot to DTC first, but it's not DTC only. Wholesale will complement our business, because we need wholesalers to reach our end consumer, just from a distribution perspective and for the wide variety of assortments we offer.
You mentioned expanding the product portfolio to increase your total addressable market. I'm curious from your perspective in your seat as the CFO, what is your thinking when you're looking at the balance sheet on a decision like that? How do you suss out the opportunities that are going to cost you guys a lot but potentially lead to long-term growth versus those that may be expensive and not necessarily give you the ROI that you're looking for?
Yeah, no, it's a very, very good question. Both as CFO and with my growth officer role, as we're making this pivot to a DTC first company, we have a project and that's called Fuel, which is really about rewiring the company. We are looking at our go-to-market calendar, and our thought is that we can make it shorter and faster and get a lot more agile. We have already reduced our SKUs, which will begin impacting in the first half of next year by close to 15%, and I think we can go more. By doing this, our view is we create the capacity to really expand the TAM. And we had talked about dresses and skirts for her. We talked about the non-denim offer for him, etc. And so being thoughtful, because our view is we can improve our inventory turns. Right now, our turns are about 2. We can get to 3 while expanding TAM, while adding SKUs on the stuff that's really working, but actually reducing SKUs on the assortments that are not working. So we're getting a lot tighter. Our global assortments, something that you have and you can offer across the world. We're increasing that by being more directive in our assortment because the consumer is largely similar everywhere and wants our product that's relevant. And so, by ensuring that our common assortments around the world are a lot more than what they're today, I think will just lead to that result.
Harmit, Levi's is not alone, at least this week, calling out weakness in China. General Mills called it out in its earnings call yesterday, talking about weakness for Haagen-Dazs ice cream bars, which I think caught a lot of people by surprise. No question, weakening consumer sentiment in the country. What's your diagnosis? Is this Chinese consumers having negative sentiment against U.S. brands ahead of the election, or is it product-oriented? How do you guys diagnose what's going on there?
Yeah, we have a wonderful team in China that is looking to grow that business. China in China is a small piece of a business. It's about 3% of our business. Q2 was, what I call an out-of-sequence quarter because it was lapping the reopening of the Chinese economy a year ago. And, last year, China grew to 95%. And, in Q2, we said the business was down about 10%. But it sequentially, year over year, or month over month, got better as we exited the quarter. I think it's more the macros, Brian, because traffic is under pressure. What we are really doing to bring the consumer back into our store, we are introducing more locally relevant products. So think of Performance Cool, which is we're making a big play just because it's lighter denim that's working as the world becomes a lot more warmer. So we introduced that's working. The Chinese consumer has a slightly different taste. So we're making the product a lot more locally relevant, like we did in India. And I think that will make a difference over time. We're not planning for a lot of growth in the second half of the year from China. It takes a little while to make the assortment change. But we're really long on international. We expect Europe, for example, to return to growth in the second half. We're seeing that in the orders we're getting from wholesale customers. Our DTC business is sequentially improving. It was up high single digit, and we think that momentum continues. So, thinking about international, international is about 60% of our business. We think it can be a higher business and is obviously higher gross margins. And we have teams on the ground working really hard to get there.
All right, Harmit, we're going to have to leave it there, but thank you so much for joining us this morning. We really do appreciate it. That was Harmit Singh, Levi Strauss Co. CFO and Chief Growth Officer. Also joining us and bringing us this interview, Yahoo Finance's Executive Editor, Brian Sozzi. Thank you so much.